Tom Lee just made a new prediction about the 2026 crypto bull run. And if he's right, waiting even 60 days for confirmation could mean missing the entire first leg of the move. The part almost everyone gets wrong is assuming the danger already passed, when the real risk is positioning too late for what comes next. Because what if the 4-year Bitcoin cycle doesn't quietly fade out sometime in the future, but instead breaks in a very specific way that forces the market to reprice everything fast? Not gradually, not politely, fast enough that most people watching this will feel smart one week and completely offside the next. Put yourself here for a second. You watched Bitcoin grind higher, then stall. You watched the market get hit, liquidity vanish, and leverage unwind. And you told yourself, this feels familiar. End of cycle. Been here before. That assumption is exactly what Tom Lee is challenging. And the reason his new call matters isn't the upside number, it's the timing. Because if Bitcoin clears one level early in the year, not later, not after the halving stories recycle again, then the entire playbook most crypto investors rely on quietly stops working. And the cost of being wrong isn't theoretical. It's missing a move that doesn't give you time to catch up. Here's what most people remember. Bitcoin had a solid year going. Momentum was building, confidence was back, and then it wasn't. Prices rolled over, gains disappeared, and the market narrative snapped back to disappointment. Same old crypto, too much leverage, too much speculation, another cycle that couldn't hold. But that surface-level story skips the most important detail. According to Tom Lee, Bitcoin didn't fail, it got interrupted. And that distinction changes everything. Because what happened wasn't a slow loss of demand or long-term holders giving up. It was a violent mechanical liquidation event that erased positioning in a way the market rarely sees. Bigger than most people realize. Bigger, in some respects, than what happened during FTX. That sounds dramatic, but stay with me, because this is where the investigation starts to matter. When people say the market broke, they usually mean price went down. But price going down is not the same thing as structure breaking. Tom Lee's entire framework hinges on separating those two things. So let's rewind to the moment that actually matters. Going into that period, Bitcoin was up meaningfully on the year. Sentiment wasn't euphoric, but it was constructive. Positioning had rebuilt, leverage was back, but not in a reckless way. Then a macro shock hit at exactly the wrong time. Traditional markets were closed. Crypto wasn't. That alone already puts pressure on digital assets, because crypto becomes the release valve for macro fear when everything else is paused. Under normal circumstances, that still wouldn't have caused what followed. Crypto is volatile by design. Big moves are baked into the system. The real damage came from something most people never look at closely: collateral mechanics. A huge number of traders were using stablecoins as collateral for leveraged positions, and that part is important because it's not reckless behavior. It's normal. It's built into how crypto markets function. Stablecoins are treated like cash. They're supposed to be the least exciting part of the system. They're boring on purpose. You don't think about them. You don't worry about them. You don't check their price every hour. You assume a dollar is a dollar, and the entire leverage engine of crypto is built on that assumption. So when traders post stablecoins as collateral, they're not making a speculative bet. They're doing what the system encourages, using something stable to access exposure elsewhere. That's why this next part matters so much. During that shock window on one major exchange, internal pricing for a popular algorithmic stablecoin briefly broke from reality. Not the global market, not every exchange, not the broader ecosystem. One exchange. For a short period of time, the internal price that exchange used to assess collateral dropped far below where it should have been. Not because the stablecoin actually collapsed across the market, not because confidence disappeared everywhere, because of a localized pricing failure. And this is where things go from normal volatility to systemic damage. Risk engines don't ask why. They don't care about context. They don't wait for confirmation. They respond to numbers. So the moment the internal price dropped, every account using that stablecoin as collateral was instantly reclassified. Positions that were perfectly healthy seconds earlier were suddenly flagged as under-collateralized. Not because the traders were wrong, not because their positions failed, because the system decided their collateral was suddenly worth far less. That single mispricing flipped the switch. Automatic deleveraging kicked in. And automatic deleveraging doesn't negotiate. It doesn't stagger exits. It doesn't care about market conditions. It does exactly what it's designed to do, immediately. Positions were force closed, not selectively, not carefully, all at once. And here's where the damage compounds. Those positions weren't concentrated in Bitcoin alone. They weren't neatly contained in deep, liquid markets. A huge portion of them were altcoins, smaller assets, thinner order books, assets that can handle normal selling pressure, but not sudden liquidation at scale. So when those positions were dumped into the market, there was nothing on the other side. No bids, no liquidity, no buffer. Price didn't drift down. It gapped. Some assets briefly fell by absurd amounts, 90%. More, numbers that make no sense if you're thinking in terms of fundamentals. But fundamentals had nothing to do with it. This wasn't investors deciding those assets were worthless. This was forced selling colliding with empty books. And once that selling hit spot markets, it didn't stay contained. Other exchanges saw prices collapsing. Their risk systems reacted. Margin thresholds were breached. More liquidations fired. More positions were forced closed. That's how cascades form. One localized failure spreads outward because systems are designed to respond, not interpret. Within hours, millions of accounts were effectively wiped out. Not slowly, not over weeks, in a compressed window that left no time to respond. This is why, to someone watching from the outside, it felt like the market snapped. It felt like the end. Emotionally, that's exactly how it registers. It feels like a total rejection, like something fundamentally broke, like the system failed. But structurally, events like this often do the opposite. Here's the key point almost nobody focuses on. Once forced sellers are gone, they're gone. They don't come back tomorrow. They don't sell again next week. They don't slowly bleed pressure into the market. Their positions are zeroed. Their risk is removed. The selling they represent is finished. That's why the pressure disappears almost as fast as it arrives. There's no second wave from them. There's no lingering overhang. What looks like devastation in the moment often leaves behind a cleaner market than existed before the event. Tom Lee compares this directly to 2022, but with an important distinction that changes the entire interpretation. In 2022, the FTX collapse marked the end of a cycle. Leverage had been building for years. Trust had been quietly eroding. Balance sheets were opaque. Risk was hidden. When that unwind happened, it exposed real fraud, real holes, real insolvency. That was a fundamental failure. This time, what broke wasn't trust, it wasn't solvency, it wasn't demand, it was plumbing. Pricing feeds, risk engines, collateral mechanics, the boring infrastructure nobody thinks about until it fails. And plumbing failures don't signal the end of a cycle. They signal stress points that get fixed, risk models get adjusted, safeguards get tightened, exchanges learn the hard way and update systems so the same trigger can't fire again in the same way. That's why Tom Lee frames this as a reset, not a rejection. A violent reset that removed leverage, punished excess, and cleaned the system without destroying the underlying structure. And this is where timing starts to matter. Because markets don't reward you for understanding what happened yesterday. They reward you for recognizing what changed afterward. And after events like this, what changes isn't price first, it's positioning. In 2022, after leverage finally snapped and forced selling ran its course, something very specific happened that most people forget. The market didn't bounce immediately. It didn't recover the next week. It didn't magically feel better because the bad actors were gone. It went quiet. For roughly 8 weeks, price action flattened out. Volatility compressed. Interest faded. Headlines stopped screaming. And to anyone watching day to day, it felt like nothing was happening. Not days, not months, about 2 months. That window matters more than the crash itself, because that's the part where markets reset without rewarding anyone's patience yet. It's the part where people stop checking prices, where conviction quietly erodes, where the dominant emotion isn't fear anymore, it's boredom. And that exact window has already passed since this event, which means if the analogy holds, the market isn't in freefall anymore. It isn't in panic. It isn't in discovery mode to the downside. It's in the recovery phase. And recovery phases almost never look the way people expect them to. They're quiet, they're uneven, they don't feel like opportunities, they feel suspicious, easy to dismiss, easy to explain away as dead cat bounces or temporary relief rallies. That's why so many people miss them. Recovery doesn't announce itself. It shows up disguised as nothing. And this is where the 4-year cycle narrative starts to wobble. Because most crypto investors don't analyze markets structurally. They analyze them chronologically. Everything gets anchored to the halving. The calendar becomes the strategy. The expectation is almost ritualistic at this point. Long grind, then acceleration, then euphoria, then collapse. Repeat. It's held long enough that it feels permanent, like gravity. But markets don't follow calendars. They follow incentives. Tom Lee's point is simple, and that's why it's uncomfortable. Patterns break when enough people depend on them. When too many investors are positioned for the same outcome at the same time, the market stops rewarding that outcome. It doesn't do it maliciously. It does it mechanically. If Bitcoin clears a key price level early, not after the usual waiting period, not when everyone feels psychologically prepared for it, then the entire idea of neat 4-year cycles starts to fall apart. Because the market would be sending a different message. It would be saying that liquidity matters more than law, that positioning matters more than narratives, that macro conditions matter more than tradition. And that's why this call isn't really about 2026 by itself. It's about what happens before most people think anything meaningful is allowed to happen. That's the danger zone, the part of the cycle where people are still waiting for permission to believe. And here's the part that really shakes people out. Tom Lee openly expects another drawdown, not as a surprise, not as a risk to be feared, as part of the process, potentially around 20%. That number alone is enough to make most investors mentally step back, because it sounds like a reason to delay, a reason to stay cautious, a reason to tell yourself you'll act later when things are clearer, another reason to wait. But his interpretation is the exact opposite. In his framework, drawdowns don't tell you where the market ends. They tell you how strong the foundation is underneath. Markets that go straight up without interruption are fragile. They crack the moment pressure appears. Markets that pull back, consolidate, and then refuse to collapse are resilient. They absorb stress instead of amplifying it. History backs this up, especially in equities. Periods with multiple strong years of gains are often followed by consolidation phases, not crashes. Those pauses feel terrible in real time because optimism is already priced in. Expectations are high, confidence is crowded, but that's precisely why those periods matter. They transfer ownership. They flush out impatience. They reward discipline later, not immediately. What would actually be dangerous isn't a 20% drawdown. It would be a drawdown driven by runaway leverage, by households borrowing aggressively, by margin debt exploding faster than prices. That's how systems break. That's not what's happening. Borrowing has been expensive. Leverage has grown, but it's tracked asset prices instead of racing ahead of them. That distinction sounds boring, but it matters more than almost any headline you'll read. It's the difference between stress and fragility. So when Tom Lee says a drawdown wouldn't invalidate the bull market, he isn't dismissing risk. He's reframing it. He's saying volatility is part of the confirmation process, not a contradiction of it. And that idea applies directly to crypto. Bitcoin and Ethereum don't exist in isolation. They're tied to liquidity cycles, risk appetite, and macro conditions. When those stabilize, capital doesn't trickle back in evenly. It rushes. It flows first into assets with deep liquidity, long track records, and narratives that institutions already understand. That's why his focus stays on Bitcoin and Ethereum, not because nothing else matters, but because when the window opens, that's where capital moves first. Now, before we go any further, I need to pause for a moment and say this clearly. This might shock you, but I'm not a financial advisor, and nothing in this video is financial advice. Cryptocurrencies are highly volatile, and you could lose all the money you invest. You should always do your own research and consult a qualified professional. After all, your investments are entirely your responsibility, and you should know that nothing is ever guaranteed when it comes to investing. Neither I, this channel, nor YouTube are liable for any losses. And this video is for entertainment and educational purposes only. With that said, this matters emotionally more than it does intellectually. Most investors don't lose money because they choose the wrong asset. They lose money because they misidentify the phase they're in. They wait for certainty. They wait for headlines to confirm what already happened. They wait for the move to feel safe. And by the time it does, the asymmetry is gone. The price has already adjusted. The risk reward has already shifted. And the opportunity that required conviction now requires chasing instead. That's the real cost of misunderstanding the phase. Not losing money, losing timing. Tom Lee's broader thesis stretches beyond crypto. He often compares today's innovation cycles to the early internet era, not because the technologies are identical, but because the pattern of value creation is. Most individual companies from that era failed. Almost all of them, actually, but the sector as a whole massively outperformed. The mistake people made was trying to pick perfectly instead of positioning for the trend. That lesson maps cleanly onto crypto. You don't need every token to win. You need exposure to the assets that absorb liquidity when risk appetite returns. And here's where the 2026 angle comes into focus. If the recovery phase accelerates sooner than most people expect, and if Bitcoin breaks that key level earlier than the calendar says it should, the market doesn't pause to let everyone catch up. It doesn't wait for consensus. It doesn't wait for confidence. It moves anyway. And this is the part that catches people off guard, because most investors are mentally prepared for a slow grind, a polite breakout, a few pullbacks, time to think, time to react, time to feel smart about every decision. That's not how repricing works when positioning is wrong. When the market realizes it misjudged timing, it corrects that mistake fast. That's what Tom Lee means when he says the next move won't be gradual. He's not talking about excitement or hype. He's talking about mechanics, about how quickly prices adjust when too many people are underexposed at the same time. It's violent in the sense that it leaves no room to negotiate with yourself. One week you're thinking, I'll wait for a retest. The next week you're thinking, maybe I missed it. And by the time you accept that something changed, the price is already far enough away that the risk feels worse than it did before the move even started. That's mechanical violence, sharp repricing driven by positioning, not emotion. It happens when sidelined capital realizes it's late, when short positions rush to cover, when under-allocated funds are forced to chase exposure just to stay neutral. None of that requires euphoria. It only requires realization. And this is exactly why Tom Lee isn't bothered by the idea of another drawdown along the way. To most people, a drawdown feels like failure. It feels like proof that something is broken. In his framework, it's proof that the system is doing what it's supposed to do. Each consolidation clears weak positioning. Each shakeout removes people who were never going to hold through volatility anyway. Each uncomfortable pause reduces competition for the next leg higher. Think about that for a second. When everyone feels confident, there's no fuel left. When everyone feels uncertain, positioning is thin, and the smallest shift in demand creates outsized moves. That's why by the time certainty comes back, the opportunity is already shrinking. Certainty always arrives late. Comfort is expensive. And this is where a lot of people misunderstand what it actually means to prepare. Preparing doesn't mean going all in. It doesn't mean betting the house. It doesn't mean pretending risk doesn't exist. Preparing means understanding where you are in the process so you don't confuse discomfort with danger. Discomfort is volatility. Danger is structural weakness. Those two feel identical in real time if you don't know how to separate them. Preparation is boring. It's unglamorous. It's thinking through decisions before you're emotional. It's knowing what you'll do if price moves quickly, not scrambling to decide while it's happening. It means your accounts are ready, your access works, you know where your capital is, you're not opening new accounts during a spike, you're not figuring out verification while price is moving away from you. Because once volatility spikes, friction becomes the enemy. When markets move fast, every delay costs money. Every extra step adds slippage. Every moment of hesitation compounds. This is why infrastructure matters more than most people think. Not because it sounds professional, because execution matters when speed matters. Using established exchanges with deep liquidity and proper risk controls isn't about convenience. It's about being able to act when conditions change instead of watching price move while you're stuck on the sidelines. That's also why I mentioned this part briefly but intentionally. If you're still deciding which exchanges make sense for you, I've put links below to platforms I personally use and trust. They're there to give you options with real liquidity and reliable execution. No pressure, no urgency. Just resources you can look at on your own terms before things get hectic. The same logic applies to education. The market does not slow down because you're still learning. It does not pause because you're unsure. It moves when it moves. That's why I also run a free educational Discord. It's a place where we break down market structure, macro signals, and positioning in real time. Not predictions, not hype, just context. The goal isn't to tell you what to think, it's to help you understand what you're seeing while it's happening. If that sounds helpful, you're welcome to join. Coming back to Tom Lee, his final message is quietly sobering, and it's easy to miss because it isn't dramatic. Volatility doesn't scare away structural capital, it scares away tourists. Serious capital expects drawdowns. It plans for them. It uses them to build positions. What leaves during volatility is not conviction, it's impatience. And each cycle, fewer people are actually prepared for what comes next. Not because the opportunity disappears, but because belief erodes. People get tired, they get cautious, they stop trusting their own analysis after being shaken out too many times. That's why moments like this feel uncomfortable. They're supposed to. If everything felt obvious, there would be no asymmetry left. If everyone agreed on the outcome, the price would already reflect it. So when you hear predictions about 2026, don't treat them as distant forecasts that you'll worry about later. Treat them as a lens to understand what might already be forming now, quietly, underneath the noise. Because the real risk isn't another drawdown. The real risk is assuming the cycle will wait for you the way it always has before. Subscribe or watch the next video.